Welcome back to the deep dive. If you really want to get a pulse on how the American consumer is doing, sometimes you skip the big headlines.
Right, you look at the necessities.
Exactly. Where are people spending money because they have to?
Hmm.
And today, we're going to pop the hood on the automotive aftermarket. We're drilling down into O'Reilly Automotive, looking at their Q3 2025 earnings call, their reports, getting the real story on their health, and strategic direction.
Yeah, and it's a fascinating read because, the headline numbers, they look fantastic. You've got 5.6% comparable store sales growth.
Strong.
Very strong. Operating income up 9%. Diluted EPS jumping 12% to 0.85. It's a $4.71 billion quarter. But
There's always a but, isn't there?
there is. Those great results, they actually hide a really critical split in the customer base.
That's the core theme we found, too. These, blockbuster figures mask this divergence. Not everyone's feeling the economy the same way. O'Reilly, they're really benefiting from one side of that equation.
Well,
So our mission today is pretty straightforward. We want to unpack who's driving the growth, how they're handling some serious inflation and these tariff headwinds, and maybe most importantly, where they're putting their money for future expansion.
it's definitely the shortcut to understanding vehicle maintenance across North America right now. And it really starts with this tale of two customers. You've got the professionals versus the everyday do-it-yourself person.
Let's dive right in there. The standout story from these reports has got to be the professional side, the pro service provider business. It's not just good, it's crushing it.
It absolutely is. It's the, dominant driver for the quarter, no question. Pro comparable sales growth was just over 10%.
Wow. Okay. 10%.
Yeah, which is, nearly double the overall company growth rate. And the really interesting strategic part, this wasn't just price hikes. It was mainly driven by growth in the pro ticket count.
Okay, so more mechanics, more shops are coming to O'Reilly more often, not just paying more per visit.
Exactly.
What does that signal strategically? More tickets.
It's a huge sign of market share gains. Think about it. The pro customer, your local mechanic, they need speed and availability above almost everything else.
Right. Time is money for them.
Precisely. O'Reilly's whole model is built on having the right part right now. So when their pro ticket count goes up, it means those mechanics are shifting business away from competitors, often smaller guys who just can't match O'Reilly's inventory and logistics.
And it probably helps that the pro customer isn't feeling the pinch of inflation quite as directly, right?
That's a key point. They're generally, let's say, less economically constrained than the average DIYer. For the shop owner, fixing their customer's car isn't optional, it's not discretionary.
The car needs fixing, period.
Yeah, if the car needs a part to get off the lift, the shop buys it. A 4% price increase isn't going to stop that transaction. That professional demand is just inherently resilient.
Okay, so that's the pro side. Strong, resilient, gaining share. Now let's flip the coin to the do-it-yourself, the DIY segment. How do they do?
Well, that side finished the quarter with a, quote, low single-digit comp.
Okay, so positive, but definitely not the 10% we saw on the pro side.
No, definitely not. You can see the DIY consumer is feeling the squeeze a bit more. Average ticket size did go up, meaning individual parts cost more, which helped sales.
Right. Inflation pushing that up.
Exactly. But that was significantly offset by pressure on the number of transactions, the volume. Management actually said they saw some modest pressure start building midway through Q3.
And this gets to that idea they talked about quite a bit, deferral.
Mm-hmm.
If I'm watching my budget as a DIYer, I'm probably only fixing what absolutely needs fixing right now. What kind of jobs are getting pushed back?
Yeah, the pressure was really felt in those larger ticket categories. That's where you see the potential for deferral of major expensive jobs. Routine stuff, oil changes, filters, fluids. Still strong.
Because you can't really skip those, right? Not if you want the car to keep running.
You really can't. Ignore your oil and, well, you know what happens. Those are non-negotiable maintenance items. But maybe it's a bigger chassis job. You need new ball joints, control arms, maybe a suspension overhaul. That's a bigger hit to the wallet.
And maybe it feels less urgent if the car still drives okay.
That's what they saw. Management gave the example. If your brake pads are, quote, metal on metal, you can't defer that. It's dangerous.
Nope, got to fix that now.
But a less urgent chassis job, maybe you can put that off for, as they said, weeks, months, but obviously not years. The DIY customer is clearly making choices, prioritizing immediate function.
That makes a lot of sense. You're balancing meeting the car with the rising cost of fixing it. Which, naturally, brings us to segment 2. How O'Reilly is handling these rising costs. How bad was inflation for them in Q3?
Yeah, the pricing environment was definitely a factor. They reported same SKU inflation during Q3 at just over 4%.
Okay, and just remind us, same SKU means?
It means the price increase on the exact same part compared to last year. So yeah, a true apples to apples comparison.
Got it. 4%. Was that across the board?
It was. Felt pretty evenly across both pro and DIY, according to the reports, and they were clear. This wasn't them just deciding to raise prices. It was driven by a, quote, significant ramp in tariff-driven acquisition cost increases.
Ah, the tariffs. So global trade issues forcing their hand on raising retail prices?
Essentially, yes. They had to make selling price adjustments.
So what's the outlook then? Are we going to see another 4% jump next quarter? Or have things maybe stabilized?
Well, the outlook seems a bit better. They anticipate a mid-single-digit same SKU benefit in Q4. That suggests the rate of increase might be slowing down.
Okay, mid-single digits, maybe slightly less than 4%.
Potentially. And here's the key statement. Management said they believe they have seen the, quote, lion's share of the cost impacts from the tariffs that are currently in effect.
That's a pretty bold statement, the lion's share. It suggests they think they've absorbed the worst of the known tariff costs into their current pricing.
Right. They acknowledge the whole tariff situation is still, fluid, things could change. But based on what's currently implemented, they feel most of the impact is already baked in. Gives them a bit more stability, hopefully.
Okay. Now, even with that, we know the DIY customer is cautious, deferring jobs. Are they starting to, trade down, choosing cheaper parts to save money?
That's the logical next question, isn't it? If prices are up and budgets are tight, you'd expect people to buy the cheapest option.
You would.
But interestingly, no. The company explicitly stated they are not currently seeing a significant trade down to lower-priced goods.
Really? So people are still buying the better, maybe more expensive option?
In some key categories, yes. They actually see customers trading up for better value or longer warranties. The example they gave was batteries.
Huh. Batteries. Okay, why batteries?
Well, think about it. A battery is critical. If you buy a cheap one and it fails prematurely, you're stranded. Maybe you've wasted money. The perceived cost of failure is really high.
Right, the hassle factor alone is huge. Plus, having to buy another one sooner.
Exactly. So even budget-conscious consumers seem to be prioritizing long-term value and reliability for critical parts like that. They're looking for value, not just the absolute lowest price tag, maybe trusting O'Reilly's private label brands more too.
That's fascinating consumer psychology right there. Okay, so if the DIY side is cautious on price, O'Reilly needs other growth avenues, right? Which takes us straight to their expansion plans. They seem to be hitting the accelerator.
Oh, absolutely. They're accelerating unit growth quite aggressively. For 2025, they're on track for their target of 200 to 210 net new stores. They'd already opened 160 by the end of Q3.
Okay, hitting the target.
But the big news is 2026. They're increasing that target significantly. 225 to 235 net new stores. That's a major vote of confidence in their model and the market opportunity.
Wow, okay, adding another, 10, 15% more stores next year than this year? That requires a serious infrastructure commitment. Where are these new stores going?
The bulk will still be in the U.S., spread across the 37 states they're already in, plus Puerto Rico. But the really strategic long-term play is international.
All right, they keep mentioning Mexico.
Yeah, Mexico is consistently called a huge opportunity, basically an untapped market for them over the medium to long term. They see massive potential there.
And the other big international news, the one that really signals North American ambitions.
Canada. They officially confirmed they are starting their expansion into the Canadian market in 2026.
That's huge. Crossing the border isn't just adding stores, it's a whole new ballgame: regulations, logistics, supply chain.
Exactly. It shows enormous confidence in their operational playbook. They believe they can replicate that right now model effectively in a new country.
And supporting all this expansion, especially that crucial pro-growth, requires a strong supply chain. They're investing heavily in distribution centers, or DCs, aren't they?
Yes, big time. A brand new state-of-the-art greenfield DC is opening, or it just started servicing stores, actually, in Q4 2025. It's in Stafford, Virginia.
Stafford, Virginia. Why there?
Location, location, location. It strategically targets the really dense, high-volume Mid-Atlantic I-95 corridor. That's a market they previously couldn't serve quite as efficiently. This new DC is all about capturing more of that lucrative pro business in the Northeast.
Makes sense. Build the infrastructure to support the growth. Now, I did notice one thing in the reports. They lowered their capital expenditures, their CapEx guidance, for 2025 by $100 million. Should we read anything into that? Maybe a bit of caution creeping in?
That's a fair question. $100 million is definitely real money.
Right.
But the company's explanation was pretty clear. It's mostly about timing. Projects getting shifted from late 2025 into early 2026 due to normal construction or permitting delays, things like that.
Ah, okay. So not pulling back, just the calendar moved a bit.
That seems to be the story. And the fact they simultaneously raised the 2026 new store target strongly suggests the investment commitment is still there. The money's just landing slightly later. The overall posture remains aggressive expansion.
Okay, that clarifies the narrative. The commitment's solid. Let's shift gears to segment 4, operational management and financial discipline. It can't be easy running this kind of growth engine with inflation hitting everywhere. Where are they feeling the pressure on expenses?
They're definitely feeling it in SG&A. That's selling, general, and administrative costs. Basically, the overhead to run the business, run the stores.
Right.
SG&A per store grew 4% in Q3, which pushed their estimate for the full year slightly higher, maybe just above their original target range.
Okay, 4% growth in overhead per store. What's driving that specifically? Is it wages? Rent?
Actually, the sources point to something slightly different and largely outside their direct day-to-day control: medical and casualty insurance programs.
Insurance costs.
Sure.
Healthcare liability.
Exactly. It reflects that broader national trend we're all seeing: rapidly rising costs for healthcare and general liability. So even a super efficient operator like O'Reilly can't fully escape those macroeconomic headwinds hitting their employee benefits and risk management costs.
That's a really interesting point. It shows how interconnected everything is. Speaking of risk, what about supplier risk? The auto parts world can have its share of uncertainty. They mentioned something called the First Brands situation.
Yeah, they addressed that head on. First Brands is a supplier known to be going through some financial restructuring. Obviously, that raises questions about supply reliability.
So how exposed is O'Reilly if one supplier runs into trouble?
This is where their strategy really pays off. First, they put it in perspective. First Brands represents only a little bit more than 3% of their COGS, their cost of goods sold.
Okay, 3%.
Manageable. Manageable.
Okay.
But more importantly, their core defense is diversification. O'Reilly is dual, triple, sometimes even quadruple source for most of their product lines.
Meaning they don't rely on just one company for, say, brake pads or filters.
Exactly. Plus, over half their revenue now comes from their own proprietary brands. They have much more control over the manufacturing and supply chain for those. It builds incredible resilience against disruption from any single vendor.
That sounds like a very robust system to mitigate supply chain shocks. Smart. Okay, finally, let's touch on capital allocation. They're generating a lot of cash. What are they doing with it?
Returning value to shareholders is a big priority, mainly through share repurchases. In Q3 alone, they bought back 4.3 million shares.
Wow.
The average price was 98.088 cents per share, adding up to a $420 million investment just in Q3. Management was pretty clear. They think the stock price is well supported by future cash flows, basically. They think their own stock is a good buy.
Buying their own stock back aggressively? What about debt? Are they loading up on leverage to fund all this expansion?
They seem pretty disciplined there. Their adjusted debt-to-EBITDA ratio is sitting at 2.04x.
Okay, explain that ratio simply.
Sure. It basically means for every dollar of operating profit they earn annually, they have about $2 of debt. Their internal target ceiling is 2.5x.
So they're comfortably below their own limit.
Comfortably below. It gives them financial flexibility, plenty of dry powder for future investments, or maybe even acquisitions down the road if the opportunity arises.
Okay, let's pull this all together. What are the key takeaways from this deep dive into O'Reilly's Q3?
Well, I think first, the aftermarket is really split. The pro segment, the professional mechanic, is the powerhouse right now, driving growth and compensating for a more cautious DIY consumer who's definitely feeling inflation and deferring some jobs.
Right, and on inflation, they seem to think they've passed through the worst of the current tariff impacts, that lion's share idea, but operational costs, especially insurance, are still a persistent pressure point.
Definitely. And strategically, the big story is accelerated growth. They're pushing hard on new store openings, investing in the supply chain like that Spafford DC, and making major moves internationally, with Canada now officially on the map alongside Mexico.
They're leveraging their financial strength and operational model to expand aggressively.
Yeah, the core takeaway really is that O'Reilly's model, built on having the part available now, lets them keep taking market share, especially from smaller competitors, even when the economic picture is a bit murky.
Okay, so here's a final thought for you, the listener, to chew on as we wrap up. O'Reilly's leadership mentioned, despite all this success and growth, they still estimate they only hold about 10% market share across all of North America.
Which sounds low given how big they are.
It does. So consider this. We see clear evidence that price sensitivity is causing DIY customers to defer purchases. How might that dynamic, combined with O'Reilly's accelerated expansion aiming for 235 new stores next year, impact the smaller, independent auto parts stores, the ones who maybe can't compete on inventory depth or logistics?
Yeah, is O'Reilly's strategy basically designed to consolidate the industry even faster? And does that consolidation ultimately make them even less vulnerable to economic ups and downs over the long haul? That 10% share suggests there's a huge runway left.
Something to definitely think about as you watch how this sector evolves. That's all for this deep dive. Thanks for listening.